Today we're diving into a fascinating case, Farsoon Technologies. What makes this company so compelling right now is a stark, almost paradoxical conflict between its soaring stock price and its collapsing financial performance. So let's get right to the core of it. Between September and November of 2025, Farsoon's stock surged over 22%, a fantastic return. But, and this is the kicker, during that same period, its adjusted net profit for the first 3 quarters absolutely plummeted, down more than 85% year over year. This massive gap between market sentiment and fundamental performance is exactly what we're going to unpack. Here's how we'll break it down. First, we'll establish that core paradox of price versus profit. Then, we'll explore the market's rationale, what we're calling the strategic loss theory. After that, we'll dig into some significant risks that might be getting overlooked. And finally, we'll synthesize this all into the central tension, story versus data. Okay, let's start by trying to understand the market's perspective. How on earth does a collapse in profit get interpreted as a positive signal? Well, the prevailing narrative seems to be framing this as a strategic loss. It's a classic bad news is good news scenario. You see, on the very day that Farsoon released this terrible earnings report, trading volume shot up, yet the stock price held its ground. This type of price action strongly suggests that the bad news was not just anticipated, but that its underlying causes were seen as benign for the company's long-term future. So what were those causes? The market essentially looked through the ugly headline number, attributing the profit decline to 2 specific things. First, higher stock-based compensation. That's a non-cash expense to keep key talent. And second, increased depreciation from a huge new R&D facility, a non-operating cost. In the market's view, these aren't signs of failure. They're investments in future growth. And this is what investors chose to focus on instead. While profits were way down, revenue in the 3rd quarter actually accelerated to almost 35% year over year. This kind of top-line growth suggested that the underlying demand for Farsoon's products was not just fine, but actually getting stronger. On top of all that, you had a very favorable macro environment. You had the U.S. Fed cutting rates, making growth stocks more attractive, U.S.-China tariffs were reduced, easing trade pressures, and China suspended its rare earth export controls, which helped secure a critical part of the supply chain. These 3 tailwinds created a nearly perfect setup for optimistic sentiment. All right, so that's the optimistic story. It's coherent, it's compelling, but now we're going to peel back the layers and look at the counter-narrative, focusing on some pretty critical risks that this bullish story seems to be brushing aside. Let's start with just one number, roughly 42%. Any ideas what that might represent? This is the estimated slice of Farsoon's 2023 revenue that came from a single customer. That level of client concentration is, well, it's extreme. It introduces a massive and often hidden risk of volatility. A company's fate becomes tied to the ordering cycles of just one client, which is a very precarious position to be in. Next, let's get into the operational data with a DuPont analysis. This is a great framework that breaks down return on equity into its 3 core drivers: profitability, efficiency, and leverage. And what you can see is that the company's ROE has just collapsed from almost 13% down to less than 1%. And here is the critical insight. The market seemed to understand and forgive the drop in the net profit margin, but what it appears to have completely missed is the steady, concurrent drop in total asset turnover. This ratio tells you how efficiently a company is using its assets to generate sales. Farsoon's has been cut by more than half, which points to a serious and worsening problem with operational efficiency. So, with all that in mind, this brings us to valuation. Here we're comparing Farsoon's key valuation multiples against its main domestic rival, BLT, and a major international competitor, 3D Systems. The difference is, they really jump off the page. And just to visualize how extreme this is, look at the price-to-earnings ratios. Farsoon is trading at a multiple of over 600. That is almost 7 times its domestic peer, and more than 30 times its U.S. competitor. A premium of that magnitude implies that the market is expecting absolute perfection and flawless growth for a long, long time. Which brings us to our final section, and really, the heart of the issue here. This core tension between a powerful story about the future and a set of very challenging data points from the present. Let's put them side by side. The bullish case, the future story, is all about new growth from emerging sectors, strong policy support, and a unique global strategy. The bearish case, the current data, is grounded in today's reality, that extreme valuation, the high customer concentration, and the declining operational efficiency. What this analysis really uncovers is a classic market dilemma. You have a very persuasive story about future potential, going head-to-head with some very difficult data reflecting current reality. And right now, it's clear the market is giving far more weight to the story. And this leaves us with a fundamental question, one that goes beyond just this single company. As an analyst, how do you properly approach a situation where a powerful, compelling story about the future is so profoundly at odds with the hard data of the present? That is the central analytical challenge that this case forces us to confront.